Okay, a very good evening, everyone. So, welcome you all for the subject investment and portfolio management. So, today we will start your first session. Your first chapter is investment environment, right? So, through this chapter, you will understand overall idea regarding what is investment and what are the three key pillars of investment and what are the characteristics of the investment and how we are going to classify the investment as well as the related in investment classifications and how we are going to classify the types of the investors and what about the financial markets and intermediaries, and we will discuss all these things through the chapter. So let's begin. So before just uh, go with the definition, so rather than just memorizing these definitions, first of all, just understand the concept, the investment, what is this investment is with the examples. Okay, so just imagine two people who both want to buy a bicycle. Okay, so there are two people, person A and person B is there. The person A puts some cash in a shoebox under the bed, and person B opens a savings account and he is depositing the same amount regularly. So here both of them are kind of savings, right? But only person B is investing because person B is expecting some sort of return. If he is depositing some sort of money in a bank account, means he will receive some bank interest, right? So that expectation of the return is the one thing that separates himself from a saver from an investor. So based on this, so what is the investment is? The investment is a committing resources now in the hope of a future benefit. You are just accumulating all those resources now just with the hope of getting some sort of future benefits. That's what the investment is. Okay, so here two things always come bundled together if we are talking about an investment. That means the return as well as the risk. So if we are talking about the term investment, you should be aware of what is return, what is risk. So return means what you hope to gain. That means, let's say, for example, investment means nowadays we have so many investment opportunities, right? We can invest our money in the share market, or else we can invest our money in the bonds, debentures, or else if we are not aware of those share markets or bond market, what you can do, you can just open a fixed deposit and you can keep your you can just keep your money in the bank to earn some sort of interest income. As well as you can go with other mutual funds as well as the treasury bonds, treasury bills, the risk free investment securities are there, so many options are there. However, from that you are earning some sort of things. Let's say you are investing in the share market, you will earn some sort of dividend payments, right? So dividends you will earn. At the same time, if you are, so at the same time, um, you will if you are, let's say if you are just selling that particular share, you bought a share at 10 rupees and you are selling to the 15 rupees, means you will earn 5 rupees of capital gain. So like that you can get some sort of return in the share market. And if you are investing your money in the bond, you will receive some sort of interest, and at the time of the maturity you will receive the face value. Likewise, you can get some sort of returns from each and every investment. Okay. At the same time, there is another term we are telling. If we are talking about the term investment, the risk is also there. That means the possibility that the actual return differs from what you expected. Now let's say you are expecting uh, to earn 5,000 return from your investment. Now let's say you are purchasing a land. That is also kind of investment, right? You are investing in the uh, property, plant, equipment. So just let's say you are purchasing a land, and that price is the current price of the that is 15 million. Then you are hoping that uh, the price of the particular land will increase to 18 million from upcoming within 3 years of period. So because of some issues, because of some economic downturns, or some of the disaster scenarios, or because of the unpredictable things can happen, right? Because of that, if your land value is reducing, let's say your now land value is depreciated, not depreciated, your value is reduced to the um 14 million, means that means you couldn't be able to get the expected return, right? That is the scenario we are telling risk. If you can't get the expected return from a particular investment, that is what the risk is. Okay, the possibility that the actual return differs from what you expected. Okay, so this is the definition. Here you can see the definition. So these terms should be there. When you are defining the term investment, these things should be there. That is a commitment of resources at the present that they have saved, and the hope that some benefit will occur from them in the future. So these terminology should be there. So here you can see this flow chart. That is a kind of savings, and that is a kind of commitment, and there is a time and risk is also there, future benefit is also there. So these are the four key things that should come under the investment. Okay, so I hope this is clear. The term investment is. So the next part is, so you should know the difference between the saver and the investor. As I told you, the saver is a person who is saving some sort of money. That means we are also a saver, right? Now I'm earning 10,000, means that now just I'm spending 8,000 this month, and I'm keeping 2,000 for my future purposes. Just I'm serving in my wallet, in my pocket, rather than investing in anything. Just I'm keeping. So that is a kind of serving. Okay, that is a kind of service. So what is investment? The investor means that is different. So we are expecting some sort of return. So rather than keeping the cash in my hand, I can save that in my bank account, right? So if I am keeping for 1 month, or one week, or something, we will receive some sort of interest. The interest percentage will come to our bank account. So that is the differences between the saver as well as the investor. Okay, so we can't say the saver and investors are both of them are same. So there is a difference between those two people. Okay, and then we'll move to the characteristics of an investment. So actually, if we are talking about this investment, these are the key pillars of the investment: return, risk and liquidity. So you should know how to explain, how to define each of these terms. So income means you can receive, it can be a dividend income, interest income, or it can be a capital appreciation income. The capital appreciation means what? Sales price minus purchase price. Okay. So if you are investing in the share market, you will get dividend. And if you are investing in the bond or debentures, you will get interest. Or if you are investing in the fixed deposit, also you will get interest. So capital appreciation means in the share market, you can get some sort of capital appreciation. We can say capital appreciation or capital gain. That means selling price minus purchase price. The difference between selling price and purchase price we are telling as capital appreciation. So these are the examples for the return. So return in the sense that is a expectation, that is the cash inflow that we are receiving from the particular investment. Okay. And then what about the risk? So the risk means what? It is a kind of loss. We are losing something. That is the risk. That means now let's say um, you are investing, we are telling that comparatively some of the people are some mostly we are uh, not investing in the stock market, right? Even though we are studying, it is a good opportunity, good investment opportunity, we can earn more like that. Most of us not ready to investing in the stock market. Why? There is a high risk, high high fluctuations are there, high volatility is there. Due to that, we are not investing. So, because of that, we are investing our money, our lump sum in our fixed deposit. You are just thinking rather than taking that risk, it is better to investing in the fixed deposit so we can earn some sort of return. So, as a active investor, as a positive investor, what you have to think is if we are taking the higher risk, if we are taking higher risk, you can earn higher return. So that is the thing. If there is a positive relationship between return and risk. Okay, even though the share market has the highest risk, you can earn highest return comparatively. If we are comparing with other investment opportunities, we can just earn more and more return if we are dealing the share market things properly. Okay, so you have to be careful when you're making the decisions. If you have to make the investment decisions, right? So you should know how to evaluate the risk and return of the each and every uh, investment opportunity. So you will learn in the future how you are going to decide your portfolio, how you are going to determine your portfolio combination, and what are the investment you have to, what strategies you have to take when you are choosing the investment. Those things you will learn. So as an investor, you should know how to balance the return and risk. Okay. And liquidity. So what does it mean? The liquidity indicating that how fast you can convert it to the cash without losing any values. You should know, you should consider how to convert the particular investment to cash without losing the value. Now let's say you are investing 10,000 rupees in the share market. At the same time, you are investing to buy uh, you are investing, let's say, you are investing 1 lakh in the share market and same 1 lakh in purchasing golds. Okay, you are investing in two options, share market and golds. Now you need some sort of money for your for emergency purpose. You need some sort of money. So if you are investing in the share market, what you can do, you can just sell that shares in the share market today itself, and you can convert that into the cash. So the liquidity is high here. in case of the share market. But here, if it is a gold, you have to sell that in the market, but you have to determine the particular purchaser to sell that the gold amount. So it is lower liquidity. Comparatively, the liquidity is lower for the gold than the share market. So the liquidity also as a one of the pillar of this investment. Okay, so these are the key characteristics of the investment. I hope this is clear. Okay, so now let's move to the concept real investment and the financial investment. So now we are talking about the your subject code is investment and portfolio analyze management, right? So here we are talking about two kind of investments, that is real investment as well as the financial investment. So, in real investment means what? If we are investing in tangible assets, that means like land, machineries, new constructions, and the plant inventories, like that, if we are investing, that is what the real investment is. Okay, so real investment indicating that in order to get some sort of returns, we are investing these kind of tangible asset, physical assets. Okay. So normally, let's say we are in a economic crisis situation. Okay, there is a high inflation and the time value of money. That means the time value of money is very high and the higher inflationary situation is there. In that cases, what investors will do is, uh, if we are investing in the share market, there is a high volatility because of this economic crisis. In that cases, it is better to invest in the land or machineries, gold or new constructions, like that. So in that scenario, you can go with these physical assets. Okay, and then the financial investments means, so here the so what does financial investment means? Here it contracts in paper or electronic form, committing funds for future income. That means like normally we are talking no, the shares, bonds, insurance policies, all those things are kind of financial investment. Okay, you are just purchasing some serving certificate or insurance policies. Those are the financial investment. Those are not tangible assets. Sorry. So those are not tangible assets. Those are the like electronic papers. That can be in the form of the electronic paper formats uh, or electronic form. So you may get some sort of returns in the form of interest, premium, pension benefits. These are the form of returns you will get in case of the financial investment. Okay, so this is the difference between real investment as well as the financial investment. Okay, now we will look at investing versus financing. So, what is the difference between investing and financing? So, as you know, if you are if you are running a company, for each and every company, they have to make three kind of decisions. Okay, in a company they have to make three kind of decisions. The one is investing decision, and the next one is financing decision, and the next one is dividend decision. Okay, so these are the major decisions they have to make. So here the investing decision indicates that is what that we are telling the capital budgeting decisions. That means where a company can invest, the long term investment decision. So now let's say the company is earning some sort of profit every year. Now rather than investing that profit, just they are keeping with in their hand. So will it be possible to survive? For that particular company couldn't be survive in the market, right? So they have to investing in the new options, and they have to earn more return to run their company. So that is what the investing decision is. So company need to make some capital budgeting decisions. They need to decide where and where we need to invest. So that is what the investing is. Okay. So here financing means in order to invest in the various investment opportunities, they need some sort of money, right? They need money. If they don't have money, can they be able to invest in the investment opportunities? No, right? So here the financing means they need to have some, they need to make some sort of financing decision from where they can be able to gain the capital, or they can be able to gain the money. uh, they can be able to gain the money for their operation, for their investment purposes, whether they can be issue the shares or they are going to issue the debt. Those are the things we are calling financing. So this is the difference between the financing as well as the investing. So if we are talking about the corporate finance is the interaction between the firms as well as the financial market. Here, where financial market is the place where interest of both sides are realized. That means now let's say here you can see uh, investors are there, right? So here in this side firms are there. Here firms are there, investors are there. In between the financial market is there. So here firms means what firms will do. Firms issues the stocks or bonds to raise the capital. That means the organization need to make the capital structure decisions, right? That means financing decisions, whether they are going to issue the bonds or stocks. Likewise, they have to decide. So they will issue the shares and the bonds using the financial market. No, now let's take the company John Keel's company. So John Keel's company is there. They need uh, they need 10 million amount of the capital for their operations. Then what they will do, John Keels will issue the shares in the stock market. They will issue the 10 million worth of the shares, so those shares will be come to the stock market, right? That is what the financial market, they will issue the shares to the Colombo Stock Exchange, and all the shares will be uh, they will just establish their IPOs. And then the investors are the people, they are going to come and buy the shares of the John Keels. So they will buy or sell the securities, and they will get some sort of returns. So here this is like a chain. So firms are there and investors are there. In between financial market is there. From the financial market, both of these two parties, the organizations as well as the investors, will get the benefits. Okay, so the interaction between the investors and the financial market, interaction between the investors and the financial market is what we are calling as investment. Okay, is it clear? I hope that is clear. Okay, and then there is another concept, speculation as well as the investment. So there is a there are some differences between investment as well as the speculation. Okay, so normally, mm, uh, so investment and speculation is it is both of them are same kind of activity. That means we are committing some sort of money to hoping for some sort of gains. But but the thing is, the people who are involving in the investment, we are calling investors, and the speculation, they are speculators. Their mindset is different. Okay, so that is the difference between those two. Now let's say, you just imagine you are buying a shares in a stable utility company because you have studied its earnings and expect a steady dividend for 10 years. So now let's say there are two companies in the market. Okay, the company A and company B. So company A is providing from the last 5 years. You are just observing from the just analyzing last 5 years financial statement. You are taking and analyzing how about the company's credibility and everything. What about the profitability, and you are just getting a thorough idea regarding the A and B. But based on that, you understood that the particular A company is very stable, and they are providing the same amount of the dividend continuously, and the stability, higher stability is there. But comparatively, B has the highest high risk. There is a high